everyone, Angie with Angie Home Loans and NEXA Lending. Welcome back, guys. Today will be episode 2 of my Home Loan Roadblock series, where we cover some of the more common reasons people get denied for home loans and then look at some different ways to kind of maneuver around those issues. Today, we're going to go over having too high of a DTI, which stands for debt to income ratio. So what exactly is DTI, or debt to income ratio? We've covered this in some previous episodes, but basically what it is your monthly debt divided by your gross income. And that monthly debt would include credit cards, car payments, and your new housing payment. It's any monthly payment that you're making to pay off a debt. So it doesn't include your utilities or car insurance, stuff like that. So in order to work around having too high of a debt to income ratio, we need to focus on the things that are calculated into that, which would be income, monthly debt, new housing payment, and the loan program. So starting with debt, some options to possibly maneuver around this issue would be pay down some revolving debt, pay off some of your installment loans. You can't really pay those down because it doesn't change the monthly payment. But, if you have a low balance left on a car loan, maybe pay that off. Or you could refinance some high payment vehicle loans, or student loan, whatever it might be. You can also look into consolidating debt if it lowers the required monthly payments. They have debt consolidation loans out there. They also have credit cards will have promos where you can transfer a balance or a couple balances over to a new card at a low or 0% interest rate for sometimes up to 2 years. So those are things that you could look into to reduce the debt. Then number 2 would be income. You can increase your income, but that is sometimes a longer term option. You might have to wait 6 months to a year. You can't just go in and ask for a raise today, or start working overtime today, or get a second job today and have that count tomorrow. The raise might, however, the other stuff would need to age out or season for 6 months to a year before the lender would allow us to use that extra income. You can add a co-borrower that has income themselves to increase the overall income, which would, reduce that gap between the income and debt. But they would calculate their debt into it too, so keep that in mind. So number 3 factor would be house payment. So you could check into possibly an interest-only loan. I don't recommend these for very long periods of time, but if it helps you get into that home now while you're waiting for second income or credit to get better, and then you could refinance maybe in 2 to 3 years, that might be an option. You can also look at a slightly less expensive home and, lower that house payment that goes into the debt factor to see if that would get you into that debt to income ratio. You could also purchase an income producing home, such as maybe a house with a mother-in-law suite, or a 2 to 4 unit property where you have rents that are going to be coming in that can be factored into your income to get into that property. Number 4 would be to look at different programs. This program has a max debt to income ratio of this amount, and you're over that, then maybe ask your lender if there's any other programs that have higher debt to income ratio limits, or maybe no debt to income ratio programs. In the next episode, we'll be going over another common reason that people get denied and work our way through those issues as well. Anyway, thank you for watching, guys. Hit that follow button so you don't miss anything, and I'll catch you in the next episode.